Hello and welcome to the 5th Maritime London COVID-19 related webinar. This webinar is in partnership with Maritime London member Watson Farley Williams and will focus on how the financiers to the industry have responded to COVID-19. I am Josh Standerwick, Chief Executive of Maritime London, and for those of you who have regularly joined these webinars, you'll be pleased to hear that you will not have to endure my less than dulcet tones for much longer, as I will soon be passing the floor to Lindsay Keeble, Partner and Head of Global Maritime at WFW, who is of course a far more accomplished moderator than myself. Lindsay will be joined by fellow WFW partner George Paliokrasis, who is also Head of Greece for the firm. And last but not least, we have one of the leading bankers in the sector, Stephen Fuster, Head of Global Transportation at ING. Before we get started, I will provide a quick run through of the obligatory housekeeping notices. While we don't expect any tech issues, if we do experience any difficulties, please bear with us. We will do our best to minimize background noise, but I will apologize in advance for any pet, children or telephone related interruptions. We will be recording the webinar and it will be made publicly available as soon as we can do it. And lastly, but importantly, you will be able to ask questions in the chat box, and we will do our best to answer as many questions as we can, but we'll probably pick those most pertinent to the discussion. Much like the unrelenting spread of the virus itself, the economic effect in the shipping context has now begun to spread well beyond the cruise and the RoRo sectors. Particularly exposed are the container and dry bulk operators that were already operating in difficult markets, now compounded by the steep downturn as global trade as countries look to control the pandemic. While the market has worked quickly to try and mitigate as many short-term effects as possible, and one can only be impressed with the level of collaboration and innovation we have seen as a consequence. With Clarkson's predicting a 5% reduction in seaborne trade in 2020, it is unsurprising that we have seen governments around the world step in to support carriers through these difficult times. We can take some heart in the predictions of a U or possibly even a V-shaped recovery, but given the constant changing nature of the pandemic and the prevailing view that it is only when a vaccine is developed and made available that we will begin to be able to return to normal, trying to predict the nature and timing of the recovery is no easy task. This backdrop certainly provides our panelists with much to talk on as they examine the pressure points for both owners and financiers, the potential difficulty for owners in meeting their obligations, and the impact of state intervention on the market. Lastly, the panel will put their minds to how the pandemic may affect ship finance in the future, and one hopes to find some green shoots of optimism before we open the floor to questions. In a departure from the norm, this webinar will take on a more conversational approach, so I will now take my leave before reapparating for the Q&A and leave you in the more than capable hands of Lindsay, George and Stephen. Lindsay, over to you. Thank you.
Thanks very much, Josh. So as Josh mentioned, we're going to take and try and achieve a panel discussion on a webinar, which is something I've never done before. And we're trying to look at some of the practical implications and how we're dealing with it on a day-to-day basis, looking at ship finance. So first, Stephen, how has the ING team been coping with enforced lockdown and managing to service your clients from home?
Right, sorry, it had my audio off, not a great start. Thanks, Lindsay, and hello to everybody that's joined us. Yeah, thanks for the question. Well, of course, the reality is that the teams in London, Amsterdam, Frankfurt and Singapore are all working from home and have been now for pretty much a couple of months in nearly all cases. And what that has meant is that there's a much greater reliance upon our IT to enable us all to work remotely. And I have to say I've been very impressed with the way the IT infrastructure has stood up, both within the bank, where I think our IT teams have done a great job in getting everybody to be able to work as if they were sitting at their desks. But also actually the external IT has also stood up very well. Small exception yesterday where BT decided to remove the telegraph pole from outside my house, but luckily they got that back in very quickly. Thank you. So things from an IT perspective have worked very well, and of course we've seen a proliferation of video conferencing tools. So we've all been using those much more actively. Where we've perhaps seen some more challenges is perhaps around where signatures are required, but we've had to revert to electronic signatures, and that by and large has worked very well. But of course, the biggest challenge has been the lack of physical interaction, both amongst the teams, but more importantly with our clients. And shipping is a people business. It's very much a relationship business, not a transactional business. And that's where I think we've had to work much harder to keep those relationships going with the clients. So I know that my team have been phoning their clients perhaps much more regularly than they would otherwise do. A, because they want the interaction, but B, because we do have concerns around where the market is going, and we want to make sure that we're on top of those issues before they become major problems. But by and large, it's actually worked incredibly well.
I suppose, George, what Stephen just touched on about shipping being a very person business, and we all know that shipping closings, you're sitting around tables together, exchanging pieces of paper and documents. So how have you managed to keep the business as usual approach for your clients down in Athens?
Okay, thank you, Lindsay. Well, first of all, we too have been working remotely until some people still are, but until now, I'm actually in the office as from today. It's my first day back in almost 8 weeks. So we've had the team working remotely, and similarly to what Stephen described, from an IT perspective, our team has done very, very well to keep it all going, and we haven't faced broadband issues as well. But in terms of getting to your specific question, we have had a lot of remote closings. Signing documents has been done mostly physically rather than through e-signatures, although we have seen those being used. But effectively, we were having remote signings in that someone would go to the one counterparty to get the document signed, would then leave and then go to the other counterparty, or we would have documents delivered to those counterparts in order to get them signed and then be collected, depending on whatever people wanted. And given that during this period in Greece, most people have been working remotely, so that meant going to people's homes rather than doing so in offices. Then in terms of vessel registrations, that proved to be a challenge, although we see that everyone has adapted their practices and requirements in order to ensure that there's a smooth transition during this phase. So, I think many people have had experience of, for example, the Marshall Islands and Liberia, with Marshall Islands having a form of, again, accepting scanned documents, but on the basis that the person signing those documents would then get on a video con, whether FaceTime, Skype, or anything, with the representative from the registry in order to confirm and ensure that they were the person signing that document. Liberia has done similar things in terms of and introduced practices to accommodate the restrictions we faced. We also saw that this was something that we were able to deal with the Greek registry, which, let's say, is not as high tech as maybe some of the other flag states. And but we did face issues with notaries, because during the lockdown period, notaries in Greece were permitted to carry out a very limited set of tasks. So, for example, they would be allowed to notarize wills. Nothing was prescribed for shipping, but when it was clear that a particular task, a particular notarial deed was absolutely necessary in the circumstances, we would get a notary to notarize the documents, but then you would have to arrange a particular time at which you would drop off the documents at the registry, and you weren't allowed in the registry. So we face challenges, but in cooperation with the other service providers, have been able to find ways to overcome the challenges we faced.
So it's good to hear that shipping can get with the 21st century a little bit, and maybe that is some positive changes for the future of the way we do closings. Just touched on in the introduction, Stephen, about the cruise industry, and obviously that's very well publicised, and it's public companies, and obviously the European ECAs are offering payment holidays. But have you seen in other sectors, in the more mainstream shipping, that your customers are talking to you yet about payment holidays or financial covenant waivers purely because of COVID-19?
Well, we are having, I guess, very initial discussions with a small number of clients. But if we sort of take the three main sectors, so tankers, dry bulk, containers. I mean, right now, of course, we're not seeing any requests for relaxation at all, given where the tanker market is. And if we were seeing such requests, that would be very strange. It's not to say that we won't see requests going forward, and maybe we'll talk a bit more about what we think about the markets going forward. But right now, on the tanker sector, no requests, of course, no surprises there. On dry bulk, I mean, the first point I would make is, yes, the market is very weak, with all vessel sizes trading below cash break even if you're operating spot. But the market has been much lower before. If we think back to, I guess it was 2016, the market was much worse than it is now. And I think we have to sort of keep that into context. I think what we and probably the market had expected is that in dry bulk, Q1 is traditionally weak, and we'd expected a bit of a rally in Q2, which we didn't really see. We did see rates pick up, but they've been slowly drifting back down, and rates never got above cash break even. So that's where we're seeing today most of our requests that are coming in, and at the moment they're very informal, and it's really owners who are being proactive and coming to us and saying, look, this is our position today, and we're okay today, we're okay next week and next month, but if this carries on for another quarter, we can see that there is going to be some stress in our cash flow. We can see that we'll be sort of starting to breach some covenants, and we welcome the fact that they're coming and talking to us before the event, because that way we can find a way forward which works for both sides. So I think that's really actually very helpful. But to date, the requests have been pretty limited, I would say. On the container side, the container business is a very complex business, and it's typically very high volume, low margin. And Q1 was kind of okay. Q2, from what I hear, isn't going to be great, but I think there's a lot more concern around liners as we move forward over the coming months. And we hear unsubstantiated rumours that some of the liners are already going to the tonnage providers, talking about charter reductions, and that will have an effect on us ultimately, when we're financing those tonnage providers. But I think in summary, we've seen a few requests, not many, but I expect we will get more.
And then what about loan to value covenants? Is that something that you would particularly look at? Because I suppose valuations are going to be hit as well. Is it a trigger for you?
Well, most of our transactions do have loan to value covenants. Not all of them, but certainly the vast majority of them do. But it's one covenant usually amongst a package, and it's not necessarily the only one we look at, of course. It's a helpful covenant in as much as it's quite definitive typically, and we can use it to get the owners to the sort of table to have a discussion, if you like. But really, the most important thing in any loan transaction is about protecting the cash flow, because it's the cash which you want to repay your loan. No bank wants to foreclose on a vessel. That has to be the nuclear option, and really you would only do that if you believe the bank can operate the vessel better than the owner, and that's rarely the case. Unless you've got an uncooperative owner or a dishonest owner, then you don't want to be doing that. So, to answer your question, yes, it's something we look at, but it's not the only thing we look at. And if there's a cash flow there, then I'm more focused on protecting the cash flow than enforcing a loan to value covenant.
George, would you say that's the similar position in the Greek market? Because you have, maybe ING stands out as a certain type of lender compared to maybe some of the more alternative financiers.
Yeah, I mean, I would say that the picture is slightly different here, given one, the extent of the shipping companies involved in dry bulk in Greece, and those which are exclusive to that sector. So, and therefore, a greater proliferation of small to medium-sized companies. And therefore, we know that lenders to that sector, to the dry bulk sector, who have great exposure to the dry bulk sector, and have a bigger exposure to the small and medium-sized companies, have seen more traction from their customers in terms of requesting deferrals, but predominantly deferrals rather than covenant waivers. Now, in some cases, and this goes quite a bit to Stephen's point as well, it is, people are sort of dipping their toes in the water and highlighting the fact that there may be issues in the future, and wanting to be proactive, while in other cases people are expressing the view that they are already under great stress and view that this won't change in the coming months. And then so that is certainly, so the picture is slightly different here, but we've also seen, and it's not just the case that this applies to the medium-sized or small companies, because we have seen an example of a significant company within this space, which has gone to a big international lender, requesting a deferral, which was granted. But all these things need to be put in the proper context, because the bank in question has a long-standing relationship with the customer. That customer has been proactive in other downturns in the market and have proved their worth. So that is something significant. Now, where we have seen a greater rush, let's say, to deferrals or requests for deferrals, is in the alternative finance space or the non-traditional finance space, where, given the pricing of those deals, any drop in revenues or any sustained drop in revenues will have an even bigger impact on the ability of those companies to service their debts. So there is, you can make a distinction there. I'm not saying it's across the board, but you do see that the requests have come quite strong there. In terms of MVC waivers, not something we've experienced so far, and it may be the case that this could be linked with quarter or half-year dates as well, as to when someone will take valuations. So, but that's not something we've experienced so far from our clients or in this market.
Steve, a comment.
Lindsay,
Yeah. I was I was going to say that.
In relation to the loan to value covenant, I mean, perhaps for ING, it's it's arguably less important for us than it is for other banks, because we're very much, and this goes back to the point I made at the beginning, we're very much a relationship bank, not a transactional bank. So when we look at transactions, the most important thing for us is who is our client, what's their track record, what's their integrity, what does their balance sheet look like, what's the capital stack, what's their access to liquidity, etc. We don't have such a strong eye towards the asset themselves as perhaps the more traditional ship finance banks, where I suspect that a loan to value covenant would be much more important for them, because their approach, as I say, is perhaps more transactional, whereas for us it's more relationship driven. And we recognise that this is a cyclical industry. We know that values can move up and down considerably, but I think we also believe it's a mean reverting industry. So you might be down today on your loan to value, but I think there is an expectation that if they can keep the cash flow going, the values will come back.
I suppose, I think that it is important to differentiate, I suppose, between what you as an individual institution value. There's a saying, isn't there? Never seek. You always take advantage of a good crisis. So have you seen owners coming to you when you think actually this is just a bit of a try on, and they don't really need the help, but they're trying to take advantage of the situation we're in? Yeah,
I guess it depends upon your own personality, Lindsay. Whether you're cynical or whether you're more sort of kind. As I mentioned, we've had some informal approaches where owners have come to us saying that they think they may need some kind of repayment holiday or whatever. And when you look at their underlying cash flow and their cash balances today, you kind of think, well, I'm not sure you necessarily need that now. And when you sort of challenge them, they say, well, no, possibly we don't, but we have a very negative outlook on where the market's going. And that's where I say, are they being opportunistic, or are they just being very prudent? I hope my clients, and I believe they are just being very prudent. But there will certainly be, some companies who make these requests on an opportunistic basis. But I think what they will realise is that if banks agree to them, they will seek to lock the cash down one way or another. So there'll be no dividends. There'll be very limited and only essential capex, probably cash sweeps, etc. as well. So the owner won't necessarily benefit from that opportunistic approach if it really is opportunistic, because banks will seek to make sure that the cash that they've foregone can't be used by that owner to go out and buy another vessel.
So be careful with your requests is the unintended, and I think we'll talk a bit about that later, some of the unintended consequences that you may trip up. George, just another point on the practical side as well. I mean, I think we have seen a lot of owners asking us about what do I do about not being able to get my surveys done, to keep classification up to date, and practical things, crew changes. How are you seeing people dealing with that?
Okay, I'll take the crew changes first. I'll start from there. I mean, that has caused very, very serious difficulties, both logistical and practical, on behalf of on the part of owners. So it's, someone I was speaking to told me, explained some practical difficulties getting in a new crew to replace an existing crew in Asia. The first logistical difficulty was ensuring that you could find flights to go there, because that's changed a lot, and there were no direct flights to get there. The second aspect they faced, the second difficulty, is then that you then had to put the new crew into quarantine for 14 days, and you had to make sure that everything was coordinated so that the 14 days would expire when the ship would be in port, and allow people to get back on board. That also meant that the crew leaving the ship, in that particular case, would be placed again in quarantine for 2 weeks in the same country before being allowed to fly out, go home, and in most cases they'd have to go into quarantine again. So you see those practical difficulties, and some people have tried to mitigate through. We've seen even extreme examples in sale and purchase transactions where a buyer has agreed to take over the ship with the existing crew, so effectively with the seller's crew, until they can get to a location where a crew change can be achieved more easily. We've also seen and I've been told that Singapore, for example, has introduced visa requirements in order to stem the flow of people coming into the country. This isn't maritime related, but to do so that creates further barriers in that respect. Now, in terms of surveys and renewals, I think most people and most organizations have adapted to the changing landscape and are being accommodative. We have, however, faced a situation where a client who was selling a ship and had, prior to arranging the sale, had secured from the class society and the flag state an extension to the intermediate survey in expectation that the sale would be completed. And they then found that the sale didn't go through. The MOA had been signed, but the sale collapsed. And then when they went to seek a further extension, because the period for which the original extension had been given had expired, they then found that they weren't given a further extension by the flag state. So in order to continue trading the ship, and they had to reflag their vessel. So we are seeing lots of practical problems. In most cases, people are working around them and are finding solutions. And as I said, class societies and flag states are being accommodating, but it's more a problem in terms of seeking extensions where you have overage ships as well, or older ships.
And I think that the key point there is, I suppose, from a lender's point of view, the insurance cover and checking that if there's any class that it's been extended and that the insurance cover remains in place. And equally for your MII insurance, that it may be something that the lender on their MII policy also needs to notify their insurer. So the knock-on impact on the loan covenants is worth looking at.
Yeah, Lindsay. Taking my sort of banker's hat off for a moment, I mean, as an industry, we really shouldn't underestimate the challenge that crew changes are facing. And I say that because the mental welfare of the crews on board is something which, should be a real concern to all of us who are in the industry. Don't underestimate the effects of being stuck on a ship for much longer than your contract ever anticipated. That you're away from your family, and you don't know when or where you're going to be able to get off that ship and get home. And it's a real issue. And I think within the industry, there's a lot of people trying to solve this problem. But I don't want to get political here, but I think we do need more cooperation from some of the states. Sometimes you can get a new crew onto a ship, but you can't get the old crew home. It's a real challenge. If you've been on board a ship for 7, 8, 9 months and you don't know when you're getting off, you're not going to be in a good place. So we shouldn't underestimate that as an industry. But putting my banker's hat back on, if I may, I had a question for you and for George. we spoke a little bit about covenants, which is fine where they're sort of specific financial covenants and they're very measurable. But are you seeing banks trying to look at their material adverse change clauses? And are you seeing them try to invoke them, or how are they using them, if at all?
We definitely have had a lot of discussion around material adverse change and material adverse effect clauses. Early on, there was a lot of nervousness where drawdowns were happening and whether they should or could be invoked as a result of COVID-19. And I think the advice and then the approach, I think, is that we see this as a temporary. We hope it's a temporary thing, that this is going to go away. We are going to at some point go back to normal, whatever that is. So I think for there to be a material adverse effect, in order for you to call on a loan or to prevent funding, we need it to be a permanent change. It needs to be material, it needs to be a change, and it needs to have an effect on however your clause has been drafted. So I think our advice has not been of itself that COVID-19 is something which should be triggering an MAE, and it may be something which you have in a wider context that's useful for putting into the mix when you have other problems within your facility to use the MAE clause. And it has been successfully relied upon as well in isolation, but not for this COVID-19 situation. We don't think that would be something you'd want to put your neck on the line and rely upon there. George, I don't know if you have anything to.
I agree, Lindsay. The position is similar. We have been asked about it, but our view is similar, but we have heard in syndicated deals that some syndicate members have raised those type of questions to use that as a draw stop. So that's where we've seen it more, rather than in a bilateral transaction where the parties we have seen that parties have had to have a discussion regarding the changing circumstances, and there may be some give and take. But where we have seen this more, the issue rearing its head is where a drawdown is coming down on a syndicated facility, and a participant, not the house bank, is getting nervous and raising questions as to whether this could be activated.
Yeah.
Okay. Maybe on a similar kind of theme, I mean, are you seeing that banks are looking to reprice loans? Because certainly what ING and I think all the other banks are seeing too is that our cost of funding has gone up. I would say by and large across the board, but banks are trying to pass that on to the borrowers, either in relation to existing transactions or transactions which are perhaps still in the course of negotiation / loan documentation.
I suppose I think they're probably two very different approaches. So in an existing documented transaction where there are no waiver requests, where there are no other amendments ongoing, I think it's hard to see, if you have an LMA style loan facility, that you could trigger your market disruption clause. It may be more expensive for you, but the typical market disruption clause would not be triggered by this. Equally, it's not within your increased cost territory. It's not a change of law or regulation leading to a cost. But I think that's assuming you have a very LMA standard for documented facility. But I think it's obviously very different where you're asking for a waiver, people are implementing amendments, then it is an opportunity where people are seeking to, we are seeing people seek to change pricing. George, you were saying as well that some new deals where that you've had that it's changing in between.
Yeah, I mean, yes, because there are two elements. So if I just take the first one and just to make one distinction, which is that it's right that under the LMA, using LMA documents, this wouldn't be so much of an issue. However, some of the old style documents, and therefore some of the older transactions, would allow a lender to be able to recover its cost of funding if that exceeded the underlying pricing for the deal. So while we haven't yet seen and we haven't seen evidence of that being triggered yet, there is a distinction in those deals which, leaving aside, people wouldn't look at the increased cost clause, that covers something else, but there are in some old deals specific wording which would allow a lender to seek to recover those additional costs. But what we have seen, however, in the last 8 weeks or so, is where there were deals at a commitment letter stage or in documentation as well, is that we have seen that negotiations have taken place, in some cases to reprice the deals, in other cases to change the leverage on the deals, and we've even seen that the financed amount has come down. I mean, that's in only one scenario that we've seen, and so that we don't, to give a balanced picture, we have, however, seen other deals where the documentation has been accelerated in order to overcome these difficulties, which and the changing market circumstances. And in that context, also, people have relied on older valuations. So they've agreed that we will rely on this valuation taken at X date. We won't go and seek a further valuation, but that's only on the basis if we close by the 30th of March, for example, or if we close by the 30th of April. So there has been, again, an accommodation, and it does come down a great deal to what Stephen said at the beginning, which is that if there is a level of trust, a high level of trust between the parties, and a long relationship, you will view and treat those people differently if they have performed, if each side has performed, to someone opportunistically looking to take advantage of the current market.
I suppose something that we get a lot of these questions as well, and sorry, it's another one to you, George, but we get a lot of questions around force majeure clauses, and a couple of owners early doors were asking us, can I have a force majeure to stop paying my lenders? And it was quite a good idea, but it wasn't one that. But how are you seeing this evolving? I suppose it's more relating to charters and.
Yeah. It's more relating. Where we see it is charters and shipbuilding contracts. I mean, I'll just skip over shipbuilding contracts for the purposes of this clause. But in terms of force majeure, we have looked at this quite closely with our colleagues, with our dispute resolution colleagues. In general terms, and this is very, very broad brush, you won't find force majeure clauses in time charters. So force majeure as a concept is not something which appears in English common law. It is more a European civil law concept. So unless it's specifically within the charter itself, unless it's specifically prescribed in the charter, then that usually won't be an issue. There is a different concept of English law called frustration, which we've looked at as well, which has certain similarities to force majeure as to whether the nature of the contract has changed so much and the liabilities undertaken by the parties to that contract that they can no longer be performed. Again, very, very broad brush. our view is that as things stand at present, it would be very difficult for a party to walk away from a charter citing frustration. Where however, we do see issues, see issues on charter parties is where it comes to off-hire provisions, because especially on long-term or project-backed contracts, you will see strict off-hire provisions. So those could range from something like 30 days, and usually these are expressed to be 30 consecutive days of off-hire, up to 45 or even 60. So that's where people need to take care and look at the wording and ensure that the situation they're facing won't trigger those provisions. And one example, I mean, other than the obvious ones we're seeing right now, one example we have seen as well is where an agreement was reached between an owner and the charterer to retrofit the ship and retrofit it with scrubbers. And then, especially if those retrofitting projects were programmed for the first quarter of this year, with a lot of those being done in Asia, a lot of those ships were unable to get into the yards. So there we've seen so far, at least at that point, that there was a lot of negotiation and people were finding their way around those difficulties. But those could have triggered unintentionally a right to the charterer to walk away from the contract.
So Stephen, at ING, have you done many financings where they are dependent on charter hire coming through, or generally would more be on the bareboat basis? I think Steve's frozen.
Yes.
Yes, he's gone. Okay. I suppose, George, a lot of the financing that you see that's charter backed, it would be more of an issue where you have more of a project financing type structure with an offshore vessel, where you have off-hire provisions and specific off-hire clauses that would have an impact into your financing. I suppose if you're financing Chinese leasing or some of the operators, that they tend to be on bareboat charter, I suppose, where off-hire isn't so much of an issue.
Correct. Although then the lessee or bareboat charterer will have an exposure to the market under a time charter, and that's where the issues could arise, where you could then get a mismatch between the income coming in from the underlying user and the lessee's obligations under the bareboat charter.
Yeah. Moving on to some of the unintended consequences that we touched on before. I suppose, and Stephen said as well, that people are coming to him to ask early doors, how do I go about this? They're approaching them for tentative discussions. I suppose owners need to be a bit mindful about these tentative discussions with their bankers, because a lot of the loan agreement clauses are very broadly drafted and could trip them up.
That's right. Because and to be honest, we have been seeing negotiations of the events of default triggered by moratoria requests or discussions with creditors. So, if you're entering into discussions with creditors to seek a moratorium or some form of payment holiday, these, in some facilities, do trigger an event of default. So they do have that consequence. So, we have seen that people can trip themselves over. I think in most cases, unless there is unless there was a pre-existing problem, in most cases we're seeing that the lenders are looking at this favorably. But people have to be aware that if they are agreeing with creditor X, financier X, some form of debt relief or a payment holiday, they have to make sure that doesn't in turn trigger a default under their other financings, because it is at least likely that it would.
Yeah, I suppose the other concern is renegotiating generally with your suppliers across the board and doing what lenders would want the owner to do, to be a prudent, careful owner, to preserve cash, as Steve mentioned before. And I suppose there is a risk that you just have to present it in such a way that you're not renegotiating substantially all of your indebtedness with your creditors, which is the typical LMA tripwire to trigger the insolvency event to default. So I think it is an area to be cautious and to discuss, I suppose, with your relationship banks first of all, as to how to approach these issues.
Yeah, that's correct. And we've seen, I mean, we have seen, for example, through the Cypriot banks, that there has been some legislation, emergency legislation was passed in Cyprus, which allows borrowers from Cypriot banks. So there's no other connection with Cyprus. So if you borrow from a Cypriot bank, and so long as you didn't experience a payment default prior to the end of February, so long as you were current with your payments until then, you are entitled to seek a moratorium from the Cypriot bank until the end of 2020. And that's a full payment deferral. And also, you will be entitled to an extension of the maturity of that loan by an equal period to the deferral period. But however, in order to do that, you do have to submit a statement which says that you are unable, because of COVID-19, to continue servicing your debt. So that in itself could trigger what we were discussing earlier.
Yeah.
And therefore needs care.
Yeah. I had a similar discussion with one of our New York partners, actually, because I had a query about the CARES Act, and it's the US CARES Act payroll. Stephen's back. Good. Hi, Steve.
Hi. Technology problems. Me having said that the IT's been working so well, clearly tempted.
So we've answered all the bankers' view, the lawyers' view as well. So
very good. Thank you.
We're just talking about, so the sort of US CARES Act is like a payroll loan that borrowers can take out if you're a US company. And again, we were discussing you have to be cautious because by incurring that loan, you're incurring financial indebtedness. So depending at which level you're taking the government support, you could trip yourselves up on your non-incurrence of financial indebtedness covenant, for example. So that's another thing to be aware of. I don't know, Stephen, have you just gone on to audio only, or he's dropped again?
I've turned my
camera. Yeah, so I think, Stephen, just a question to you then, to the black box. A question to you is, if what's your advice to customers that want to discuss with their lenders the financial situation they're in, and they're conscious that they don't want to trip up these events of default? So we were suggesting that most people would be pragmatic, but you may have people in your syndicate that have exited shipping or sold their loans on. What's your advice in that situation?
Well, we would always encourage the borrowers to be open and transparent with us. And to come and talk to us, and where
can't hear you that well.
Where can you hear me now?
Better, yeah.
Yeah, I was saying that we would always encourage our owners to be open and transparent and come and talk to us, and where they're taking finance, perhaps from sort of through various government schemes, then I would expect that banks will be pragmatic. It has to be in all of the stakeholders' interests to make sure the companies get through this dreadful situation. And if that's what it takes to do it, then I would hope that banks will be sensible. The problem comes, and this is what you've alluded to, in that
in a syndicated transaction, the biggest obstacle to getting something approved is in fact the banks themselves, and that's because the banks have different positions, if you like, different agendas. So you may have some banks who just want to exit shipping, and they will be the difficult party in the hope that it's taken out. You may have some lenders who have bought into a transaction in the secondary market at a discount, and therefore they have a different.
Steve, I think I might just interrupt you there. Sorry, because we were having real difficulty hearing you. So
to the original lenders, and really it's up to
maybe then, George, I'll just maybe just wrap up with just how do we see this pandemic really just changing the way that we're going to be doing business in the future?
Okay. Well, I think generally in terms of how people actually work, I think the whole world has seen that we can work away from our offices, and we can do so efficiently and effectively. And it has shown that we are able to adapt very, as the human race is very able to adapt to changing circumstances. I think that in the immediate term and probably the medium term, we're going to see much less foreign travel. So the characteristics which Stephen mentioned at the very beginning about this industry being considered to be still a relationship-based industry, and I think to a great degree it is, we will have to adapt because we won't be able to have as much face-to-face contact as we did before. And yes, we will lose certain aspects from an inability to meet each other physically, but we will have to adapt for that at least in the medium term. And then the other question is whether this will act as a trigger. And I know that there's been some discussions about this in other fora within the maritime industry as to whether this will accelerate further changes. So whether this will result in further changes towards more environmentally friendly and an advancement of the green agenda, which is something which has been suggested by a number of prominent people within the industry very recently. So I'm not looking back, but it's some aspects which have been discussed post the onset of the pandemic. But I think we will see some of those changes. We'll see how much of those are going to be long lasting.
Thanks. That probably brings it into our discussion. Joss, do you want to go to the Q&A from some of the questions that have come in?
Yeah, absolutely, and thank you both for a fascinating discussion. And Stephen, if he can hear us or not, obviously the chaps from BT are still playing with his telegraph pole or something along those lines. But Stephen, you're back. Good to see you here. Fantastic.
Yeah, I've been listening all the time.
We've had a number of questions in on the question bar. A lot of them, you'll be pleased to hear, have already been covered off in the discussion. But I'll move straight to one from Stuart Kilpatrick, who's asking in the context of COVID-19 whether anyone is doing any bareboat lending or leases at the current time. And probably best for Lindsay or George to cover that one off in the first instance.
Yeah, I mean, I'm actually discussing with our Hong Kong office overnight, and they're definitely very active still in the Chinese leasing, say leaseback market. I know my colleagues of ours in Italy are currently actively working on a sale and leaseback transaction and lending into that sale and leaseback transaction. So there definitely are bareboat charter and sale and leaseback structures and financings ongoing. Yes.
And the same applies in this market as well. We were working during the lockdown on a significant deal involving the sale and leaseback of certain ships, and we're seeing another deal at the moment which had been in the pipeline for a while, which is now taking off with the expectation that it will close within this month. So yes, we are seeing this.
Okay, I think we've probably got one best for Steve here, and apologies for the pronunciation, but from Wilson Weira Warren, with tankers rates roofing recently, to what extent are owners seeking to repay the loan ahead of schedule, thus improving their balance sheet?
Well, we are definitely seeing that from a number of owners, I have to say. Which, you know, is good from a risk perspective, but it's not so good from an income perspective for the banks. But, you know, what we're saying to our tanker owners is, look, you know, enjoy this market while it lasts, but, you know, make sure that you keep a good pile of cash, you know, available, because we don't expect that this tanker market is going to last. You know, if I'm honest, I'm very nervous about the tanker market. If we move into Q3 and Q4, the storage story will start to unwind. But we've had some prepayments, and if they're not prepaying, we're saying to the clients, you know, hold on to your cash, don't dividend it out, you know, don't make big capital expenditures right now until things become more stable.
Yeah, well, sage words indeed there, Stephen. We've got a question here from Demetrius Pangiotopoulos regarding new legislation in Cyprus, a moratorium up to the 31st of the 12th, 2020 for all clients, or there are restrictions like the loan to be performing one or delays below 90 days, etc. Lindsay, do you want sort of, not really a question there, but do you want to try and cover that?
Or George, maybe you're more your.
Yeah, I mean the conditions which are attaching to this in Cyprus are that you have to have been current until the end of February, and then so long as you satisfy that condition and you make a formal statement that you're unable, you face difficulties paying your loan because of COVID, you then get the moratorium. So it's not subject to any other further conditions, and that applies from the moment your application is accepted until the end of this calendar year.
Thanks for the clarification there, George. One perhaps for the whole panel here from Violet O'Gorman. Can you give some examples of environmentally friendly changes that could be motivated by the post-COVID-19 industry? Obviously, this is a question that has been in the more general press recently. Lindsay, you were instrumental in the drafting of the Macedonia principles, and obviously, Stephen, you sit with me on the UK's Clean Maritime Council. Perhaps you could give some thoughts as to, in the recovery, how you think the industry may accelerate its move towards decarbonisation, or perhaps even slow down the move to decarbonisation.
Steve, did you want to go first?
Okay.
Or?
Yeah, sure. Yes, I mean, just aside from sitting on the Clean Maritime Council with you, I was also elected as treasurer of the Poseidon Principles a few weeks ago. So it's, you know, something which is close to my heart.
I think we can't hear you very well.
Honest, I don't know. I'll try without my headphones.
That's much better.
And I'll turn video off to give bandwidth. So, sorry, as I was saying, that, you know, aside from sitting on the UK Clean Maritime Council with Joss, I've also elected as treasurer of the Poseidon Principles months ago. So it's something which is close to my heart. But if I'm honest, I don't quite know how it's going to play out in a post-COVID-19 environment. I think on the one hand, what we will probably see is in
Joss,
several segments, which hope.
Steve, I think you're cutting in and out quite intermittently, unfortunately. So
we are going through a difficult period, and owners.
Stephen, I think it might be best if we pass this question over to George and Lindsay, as unfortunately your signal is still failing us.
I think it is. It's very difficult to know what is going to be driven out of this, because I think ship owners are going to be, first of all, focusing on maintaining cash and cash flow, and I think the impact of this is going to be quite long standing and hard to work our way out of. So it's I think the legislation is going to continue to be there. It's going to continue to be at the forefront of the IMO, but at the same time, people are only willing to do it when it makes sense economically. I think that's the message, and we're getting even from players like Maersk. They're commenting that it only really makes sense for them to be ahead of the game on the environmental side if others are forced to do it as well. So I think it needs to be an industry-wide thing. Otherwise, ship owners will fail to be competitive, and I think that's going to be the difficulty, is making sure that it is across the board so that everyone's on a level competitive playing field and making the most out of what we can, and taking the upside of what's happening and the positives that's happening to the environment, but equally people need to run their businesses as well.
George, have you got anything to add there?
Not really, because I mean I'll just end up repeating what Lindsay has said to a great extent, and the bits I could hear from Steve as well.
I think that's right. Well, we've now reached our allotted time mark. We do have some more questions, but unfortunately they're quite bank focused and probably more suitable for Stephen to answer. And given the current connectivity problems, it's probably best we don't look to cover those. I'd like to thank everyone for joining today. I think it's been a fascinating seminar, and thank you to the panelists for their time. As I say, there's obviously a lot to consider when it comes to ship finance over the coming months. I'd like to wish everybody in England, at least, a very nice bank holiday, and hope you get out to enjoy the sunny weather at some point. Apologies if we didn't manage to answer any questions that have been sent in. This webinar will be available online as soon as we can turn it around. And on that note, I'd like to wish everyone a lovely rest of the day. Thank our panel again.
Thanks
goodbye.
very much, Joss. Thanks.
Thank you everyone.
Bye everyone. Take care. Bye.